Hello, everybody. I'm excited to explain on video the loan estimate. Before you open your loan estimate, I promise you that it's going to benefit you to listen to this closely. The destiny of your comfort during this loan process will have everything to do with this video and understanding the loan estimate. This is a ridiculously bad document. It's a government document that we've had to use for years. And the way it works and the way it looks is literally like looking at Egyptian. So please just listen. It'll take 5 to 10 minutes. And then when you get your loan estimate, which is usually the same day or the next day, it will all make perfect sense. So in a minute, I'm going to share my screen. But before you have any questions for me or my loan officers, just take a look at this video because I guarantee it'll explain 90% of what you need to understand, and then signing the documents make it more comfortable for you. And then as we move through this loan process, you're going to understand because you're going to be able to reference this and you're going to look at it and say, oh, that makes sense. Remember when he said that, because it's really hard to understand. And I do a good job of explaining it, but it's going to be much easier while we're looking at the document at the same time. So here we go. I'm going to get the document up. Okay, now, loan estimate. Let me start off by saying that the loan estimate is a giant block of ice. It in no way is an indication of your final closing costs. It is a estimate, and typically what we do as lenders is we estimate higher because we can get fined for estimating too low, but we can't get fined for overestimating. So things like attorney fee, title insurance, prepaid interest, lender fees could be higher than they end up, and usually are about 20% higher than they end up. So this is sort of worst case scenario, and it gets better as we get closer to closing. Now, in this case, this borrower, see sales price here on the left, this borrower is buying this house, it's a condo, for $395,000. It's a conventional loan over here on the middle right, and they're borrowing $335,000. That's a 15% down loan. The interest rate that we're getting them, which is not locked. When we do loan estimates, most of the time I send out the LE. I could lock you at any time after you sign. So it's not locked when we send it, but I could literally do it same day or next day. Or if we're trying to sort of measure the market, sometimes I wait a little bit. So in this case, this is not a locked rate. This is the principal and interest payment. Okay, don't worry about this. This is just projected payments, which makes no sense because it's a fixed mortgage. So this is never going to change. So I don't know why they have that. And then on here is also the estimated taxes and insurance. And this just happens to be a condo. And here we are escrowing. You have to escrow if you put less than 20% down. If you put more than 20% down or 20% down or more, you do not have to escrow. But there's a little fee for that. But I always recommend that people escrow. Now, forget what it says here for a second. Okay, I'm going to show you page 2, and then we'll get back to this. Okay, let's go to the videotape. Origination charges. Okay, now, see the origination points and origination fee? This is the cost to get to a certain interest rate. Now, sometimes it could show this, and I could have enough room in the loan to get you back credits over here under calculated cash to close. Now, I just want to look at something. Okay, so in this case, see where it says lender credits under box J? If sometimes I'm able to get the borrower lender credits against the cost to get rate. But in this case, it's a very lean deal, and so there are no lender credits for the client. So for example, sometimes under box A, you might see this origination fee at $10,000 or $9,000. But you have to go down here to see if there's lender credits that I can get you against the fee that the lender's charging. So basically, this is a buy down of the rate. Now, if this was a higher rate, for example, if we got this borrower 6.6 or 6.5 or 6.7, these origination charges, this borrower paid comp fee to buy down the rate might be zero. Typically, lenders always have an $1,100 underwriting commitment fee or some sort of fee, but these borrower paid comp fees I'm using to get you a lower rate. So don't let this scare you. This is a real number, but sometimes there's a lender credit against it. Okay? Now, box B. There's always an appraisal fee. This one is ridiculously high in the estimate. It will be more like $525. This bank just happens to estimate high, but it won't be that much. The credit report fee usually ends up at about $70 or $80, but we leave a little cushion in there in case we have to make changes to your credit report. So that's usually a little bit better number. Evidence of insurance fee. This lender lists this out. 99% of the time, this is zero. So in this case, with this borrower, it's going to be zero. And you're asking, well, why is it on there if it's going to be zero? Why? Because these are national lenders and certain things are state specific. So in New Jersey and Florida, for example, your evidence of insurance fee does not exist. And then there's an HOA fee. They call it a certificate fee with the homeowners association. This is condo only, not single family. They charge a fee to fill out the condo questionnaire, which is the finances in the condo that we have to measure to make sure that this building is lendable. So if you're buying a condo, there'll be some sort of fee that you have to pay to get the documents from the HOA. We need it to make sure that they're solvent. Okay? Now, box C. These are all title charges and attorney charges. These have nothing to do with us. We do not charge this. The title company and the attorney charge it, but we have to list it out because we're the lender. Now, in New Jersey, for example, we use attorneys. In Florida, depending on the county, like Sarasota County, they use attorneys. And in other counties, they don't. They just use title companies. So depending on where you're getting a loan, you may or may not have an attorney fee. Most of the country just uses title companies, but some states also use attorneys. So as an example, title charges are based on loan amount and based on a mandated fixed rating from the specific state. But there's all these other little things like title search, closing protection letter, doc prep, endorsements. These are called junk fees. You have the ability to have a conversation with the title company about these junk fees. The title lender's policy is the thing that is non-negotiable. That's a state mandated fee that they can't control, but you can discuss with them all of these junk fees. Okay? Moving on. Box D. This just adds everything up. So this is saying if we have these origination charges, these miscellaneous charges, and the title charges, that would be $11,000. Now, as I said, it's a little bit inflated just to be safe, and those numbers will probably be lower. Okay, now, let's go up to box E, recording fee. New Jersey, for example, has a $350 recording fee. That's to record the deed with the county. Now, Florida has a tax stamp. It's expensive. It's like $3,000 or $4,000 if you borrowed $400,000 or $500,000. New Jersey only has a recording fee. Now we get into box F and G, which is your money that's going to go into an escrow account. So when I explain loan estimates, here's how I explain it. There's things that cost you money that you're never going to get back. That could be discount fee to get a lower rate. That's appraisal fee. That's title fee. That's attorney fee. Box A, B, and C are things you spend one time, you'll never get them back. Cost of buying a house. Recording fee is the same thing. But box F and G is your money that goes into a separate account called escrow. Now, let's explain. Homeowners insurance is a little tricky because with homeowners insurance, You have to pay upfront 1 year, and then at closing, the title company will also take 3 or 4 months for the following year. Now, stay with me. When you pay your mortgage payment, if there's 3 months cushion in the escrow account, every month when you pay your mortgage payment, the 1 month's homeowner's insurance gets put in escrow. So every single month for about 9 or 10 months, you pay and you build up this escrow account. And then at this time next year, if you close this month, the insurance company needs a whole nother year premium. So that's why you pay a year, so they have a year in advance, and then you pay every month to build up the account so that next year at this time, another year is paid. Okay? Now, so there's no mortgage insurance premium on this loan because the borrower is putting 20% down. And prepaid interest, the way prepaid interest works is whatever the interest costs per day, in this case, $58.64, if you're looking in box F, for 12 days. We're estimating that we're going to close the loan with 12 days left in the month. So whatever month you close in, you have to finish that month. Then, good news, you skip the following month. So if we're sitting here in March of 2024, we're going to finish March. Okay, that's as if we close tomorrow. But actually, let me give you a better example. Say we're going to close at the end of April. Say we close with 12 days left in April. You're going to finish the interest in April, which is $704. Then you do not have a payment May 1st. Your first payment is April 1st. Why? Because in America, mortgages are done in arrears, which means that you're paying the payment on June 1st for May's interest. So that's the 30 or 31 days of interest for the previous month. But in order to set up this loan, we have to finish the interest for the month that we're in. So that's what this number is. Now, if we go to box G, remember I mentioned we pay the homeowners in advance. By the way, there's a few things that you pay in advance. You'll pay appraisal in advance. You'll pay this homeowner's insurance in advance. The homeowner's insurance gets paid, 2 weeks before the closing or something like that. And then we have to get the insurance policy and make sure it matches the loan on what they call the mortgagee clause. But you pay this in advance. And then in this case, they're taking 3 more months, which is $224. Okay, now, property taxes. New Jersey, for example, it's done quarterly. February 1, they're due. May 1, they're due. August 1, they're due. And November 1, they're due. Now, what happens is they typically take 5 months because the next quarter is about to be due. So in this case, if we close in the middle of April, that money needs to go to the May 1st quarterly payment that's due. So that's 3 months gone already. Then 2 more months will go into the escrow account to get ready to pay the next quarter. So think about this for a minute. If we close May 1 and a quarter's taxes go out, when you pay your payment, if we close April 15th, remember, you don't have a payment May 1, but those taxes have to go to the county. Your first payment's June 1. So if you pay a payment on June 1 and you pay a payment on July 1, now another quarter has to go out because it's due again on August 1. So that's why they take 5 months, because they have to pay a quarter and then they have to put a 2-month cushion in escrow to get ready to pay quarterly. So bottom line is, F&G is money that you have to bring to the closing, but it's your money going into a separate account. Okay. Now, with title insurance, you can also get an owner's policy, which is very inexpensive. You're probably wondering what the lender policy is. What is title insurance? Title insurance is when you have to pay for a policy that insures the lender that if there's any back liens against the property, that back lien can't go after the property. The insurance insures against that sort of litigation. So the lender makes you pay for a policy, and then you as an owner have a very inexpensive policy that it's your choice to get or not get. Okay. So if you look at box I is E, F, G, and H combined. Okay. So if you take this number, 9912, which is I, and you take 11,628 in D, that's the 21,540 in closing costs. So then you move down here for 21,540 in closing costs. This borrower in this case is putting down $59,000, and the estimated cash to close is $80,790. So that's how that plays out. So you understand now that there's a lot of moving parts. This looks like gibberish to you because you're not in the mortgage business. This always scares people in box A, but most of the time right now, it's costing us a little bit of money to buy down the rate. Let me explain that real quick and then we'll finish up. The bond market used to pay a premium for loans, and we never had to charge points. We never had to use money to buy down the rate. What's going on right now is the bond market believes that when rates come down, which they will, that people will refi. So they're paying a lot less premium for the loans. So lenders have to either charge or use that money to buy down the rate to get to a reasonable level. So before, 3 years ago, it was very easy to do 6.375 no points. But now, if the rate's really 6 7/8, it's a wise use of this money to buy down the rate, to see what it saves you on a payment. And then we just do a return on investment, meaning if the payment's $125 cheaper and it costs $5,000, how many months does it take us to make our money back? And when rates come down, we are refinancing people either for free or almost free by taking some of my lender premium that we get paid, giving it back to you as a borrower to keep you as a customer and reduce your interest rate. And the beauty with that is we can do that over and over again. And by the way, my average customer has 4.3 over a 23-year span and $3 billion in loans. So whatever rate you're getting, we're doing our best to get you a good rate in this market, but we will be able to bring your rate down in the future. So I think that's going to answer a lot of questions on exactly how the loan estimate works. Everybody gets sticker shock. Nobody understands what it is. Listen to this carefully. I'm just taking 17 minutes of your time, which is more than I wanted to, but I think it'll answer a lot of questions. Sign the document. It's not a closing document. Anything can be changed in the LE. We can make the rate higher, which makes your buy down less, or vice versa. And things get tighter with the numbers as we get closer to the closing. And then when I lock your rate, then that's the final figures on exactly what your interest rate is costing you. And then we rock and roll, get it to underwriting, and get it approved. So thank you, everybody, for listening. I'm hoping that this is valuable to you. You can watch this over and over again because it is a confusing document, but this should help you. I'm looking forward to getting you to the closing table. Congratulations on your purchase. And if we're doing a refinance, congratulations on saving money. God bless everybody.